On February 1st, the Fed hiked the federal funds rate by 25 basis points to a range between 4.5% and 4.75%. In the press conference following the FOMC meeting, Fed Chairman Powell stated that while inflation has begun to come down, we still have more work to do. We're talking about a couple of more rate hikes before we get to that level that we think is restrictive. And if the economy progresses as we expect, it will not be appropriate to cut rates this year. Most financial market participants are more optimistic than the Fed about how quickly inflation will fall. Consequently, they're betting that the Fed will only hike one more time and that it will begin cutting rates before the end of the year. That optimism has driven stock prices sharply higher since the beginning of the year, with the most speculative asset classes performing the best. If the Fed is right and the markets are wrong, year-to-date gains won't last for long. In this video, we're going to take a look at the Core Personal Consumption Expenditure Price Index, Core PCE, to see what will have to occur on a monthly basis if the inflation rate is going to fall back to the Fed's 2% inflation target by year end. There are four main inflation indices: the Consumer Price Index, the Core Consumer Price Index, excluding food and energy, the Personal Consumption Expenditure Price Index, and the Core Personal Consumption Expenditure Price Index, excluding food and energy. It's the last one, Core PCE, that the Fed watches most closely. Here's that index going back to 1959, and here's the year-on-year percent change in that index from 1960. Notice that Core PCE peaked a year ago at 4.5%, at the highest level in decades. But since then, it's moved down to 4.4% in December. This chart provides the month-on-month percent change in that index from